My name is Jake, welcome to the channel. In today's video, I want to talk about big tech being added to DGRO in 2028. DGRO is one of my favorite dividend growth ETFs. I talk a lot about it on the channel, and there's going to be some pretty big changes in the coming years to DGRO. But the main thing that I want to cover in this video and share with you is that if you're investing into the simple path to wealth with dividend investing that I talk about here on my channel, which is SHD and DGRO is your core, historically, you wouldn't really have exposure to some of these companies because they wouldn't be included in your dividend-focused ETFs like SHD and DGRO. But times are changing, and I want to talk about that, and I want to talk about the potential impact that this could have on an ETF like DGRO in the next 5 years. Once again, if you're new to the channel, my name is Jake. I retired from my 9-to-5 job at the age of 37 here last year. My entire career, my professional career, I worked in tech. So I am actually very familiar with this space. I worked for my entire career for competitors of some of the companies, or one of the companies that we're going to talk about in today's video. So I have some interesting takes, I think, that might be of value to you if you're interested in this topic. And in order to be added to an ETF like DGRO, a company has to have at least 5 years of consecutive dividend increases. A lot of great companies get close to being added to DGRO, but don't end up getting added. They get so close, but yet they're so far away, and it could look a little like this.
I almost had it.
Oh my gosh. Oh man. All right, cool. So here, first off, what I want to talk about, I want to briefly highlight, DGRO, the methodology behind the fund. I made a couple of videos on DGRO. I will leave a link to one of the videos that I made here recently on DGRO, and you can watch that video next. But essentially with DGRO, it's from iShares, but they're tracking an index that is actually created by Morningstar. And the index from Morningstar is the Dividend Growth Index, focused here on the US. They have an international version as well. So with the US version, what it does is it looks at all eligible companies in the US market, and it excludes companies that are, for example, REITs, real estate investment trusts. So this will be 100% qualified. They focus on a dividend yield that is not in the top 10% of dividend screen X REITs. So you're not going to get a lot of yield traps when it comes to this because it's not including the highest paying dividend stocks out there. Okay. And that's important, especially when they do the rebalance every year and they reconstitute, add and subtract different companies. It's really good that they exclude that. So another thing that's important here with this index is they do not include companies that have a payout ratio of over 75%. So you're not going to get a lot of sin stocks. You're not going to get a lot of slow growing utility companies. So it's more focused on, or more skewed towards growth. And then lastly, they have to have at least 5 years of consecutive dividend growth. And then from that bucket of companies that are left over that meet that criteria, the remaining stocks are weighted in proportion of their value of their dividend payments. So the companies that pay out the most in dividends relative to the amount of shares and the dollar amount, and then it's reconstituted and rebalanced. It's reconstituted annually and rebalanced quarterly. So in a nutshell, that is how DGRO works, and it's a rule-based index. It's not an actively managed index. So now that we understand how DGRO works, when a company starts paying a dividend, they're not going to be immediately added to an index like DGRO. They have to meet the criteria to be first added. So Meta just announced that they're going to be paying a dividend. And this is the first dividend that the company is ever paying. And now, obviously, they're not going to be added to DGRO right away. But if they were to continue increasing their dividend year over year, they would then be considered for for DGRO, and they would be included into DGRO. Now, this is just pure speculation on my end. I have my little crystal ball in front of me. I'm rubbing it here, so just take everything what I'm saying right here with a grain of salt. I can't predict the future, but when a company like Meta initiates a dividend, they're doing this for a strategic reason because their business has reached a point in time of their maturity where it makes sense for them to now start paying a dividend. They're no longer in that super major growth phase of their company's existence, but rather they're more at a mature state. And when a company like Meta starts paying a dividend, it's like something that we saw in the past, like with Oracle and other, tech companies. They do this because they're entering a new phase of their life cycle as a business. Okay. And so it would be very unwise of the management of Meta to pay a dividend and not grow it. The market would actually punish Meta for doing so. So this is a strategic move from management to initiate and start paying a dividend. And so that is why I'm speculating, and I can say with pretty good confidence that in 5 years, you will see Meta platforms as one of the largest positions in DGRO. Okay. And that has to do with how DGRO is structured, is based off of the payments. And I'll get to that here in just a second. Another one that we're going to see here in 2028 very likely is Salesforce. Salesforce, like Meta, just declared their first dividend here in 2024. And if everything goes well and they continue increasing their dividend, they may be considered for addition at the end of 2028. And so same thing with Meta. If they continue paying a dividend, I think it's very, very likely that you're going to see them included into DGRO in the future. Next, I want to show you why this is such a big deal, especially if you're a DGRO investor, that this is going to have a huge impact in the coming years. So historically, DGRO has not really had a lot of software. Now, you see Microsoft and Apple, they've just recently been added, the last 5 or 6 years ago. So it's all fairly new when it comes to big tech. And if you scroll down and you kind of look at the largest holdings here, you're going to see Microsoft, you're going to see Apple. These are kind of, you got hardware and application and tech side to it. They're kind of got their feet, hands in everything. You got Broadcom, you got Cisco, you got IBM, you got Oracle, which is, got applications and software, kind of like the others. And then you scroll down, you got Intuit. This is more of a pure play software company, kind of like, with Salesforce, just pure tech. These are the majority of the ones that you're going to see, or these are the largest ones that you're going to see here, in my opinion, when I think of big tech. And so in 5 years, if you were to add Meta and Salesforce, what kind of impact could we potentially see? So right now, if you were to just take the valuation of Meta and the dividend that they're paying, what you would notice is that Meta, if it were included today, it would immediately be in the top 30. It would be a higher allocation than Goldman Sachs. I'm a nerd. I ran all the numbers here before this video. You would have a higher weighting in Meta than in Goldman Sachs. So it'd be top 30. But over the next 5 years, if Meta's growing its dividend 10 to 15%, which is not unheard of, you could reasonably assume that Meta could potentially, this is all speculation, could easily be in the top 20, if not potentially in the top 10 or right around there. And that's why this is such a big deal. In the next 5 years, you could see a pretty big shakeup in terms of how big tech is impacting and the role that big tech is playing when it comes to DGRO. And if you're like me, someone who has a large percentage of their net worth in DGRO, this is really exciting to see. I love seeing how the index is evolving and changing. And it's possible that the world completely shifts in a different direction. And guess what? That's okay. That it is what it is. But the exciting part here is if Meta does well, we will do well as DGRO, dividend growth investors holding this index. Okay. And, by association, VIG, if you're invested into VIG, I don't personally invest into VIG. I prefer DGRO. But in 10 years, Meta and Salesforce, similarly with DGRO, would be considered to be included, like Microsoft and Apple were just recently included into VIG here this last year. So I believe it was last year. So that's why this is so exciting. This is why that's why I'm making this video, because it has the potential to have a big impact in the coming years on DGRO. So we've talked about Meta, we've talked a little bit about Salesforce. Now I want to focus a little bit more on Salesforce and share, because I know Salesforce more. I worked for competitors of Salesforce. I used Salesforce for my entire career. So I know it a little bit more personally. And I want to share with you, if you don't know about Salesforce, I want to show you why this is so cool and why I'm so excited. So with Salesforce, if you invest into VGT, the Vanguard Information Technology Index Fund, Salesforce is the 5th largest holding in this index. So Salesforce, if you're just a retail investor and you don't use business software, you're never going to hear of this company. If you work in tech or in behind a computer, you probably have touched software from Salesforce. But this is a pretty big deal. And if it's included in the VGT and then it got potentially included into DGRO, you're going to see a lot of potential for dividend growth. Okay. And so the next thing that I want to do is I want to kind of walk through a little bit of a comparison. And this is me just kind of speculating on what we could potentially see from Meta and from Salesforce. Now, Meta is kind of its own little beast here. With Meta, I think Meta is a little bit more cyclical. They're more prone to market recessions and business cycles and economic and geopolitical conditions. Whereas with Salesforce is much more recession proof than Meta. And so I have Meta in here, but really I want to focus on Salesforce because I think it's a little bit easier to compare. Okay, at least from my experience and my understanding of this. So if we compare Salesforce, Intuit is like your TurboTax, right? If you do your own taxes through TurboTax or QuickBooks, if you own your own business, you got Microsoft, you got Oracle, you got SAP. Oracle and SAP are just in here as an example, but they're not really comparable. The most comparable would be with Intuit and seeing how the dividend growth of Intuit would compare with Salesforce. Okay, so I just want to highlight that, but let's take a look at this. I don't want to look at the performance as much. I want to look at the revenue growth and the dividend metrics as well. So one thing that I want to take a look at is, first off, let's take a look at the payout ratio. The payout ratio is what they're paying of their earnings. And when we're looking at tech, generally they have a lower payout ratio. The lower the payout ratio, the more room for them to increase and raise their dividend. But most tech companies, they have a target range of their payout ratio so that they can continue to reinvest in their business, do share buybacks, and create other shareholder value. It's not just about the dividend like you would see more with a Coca-Cola, PepsiCo, or something like that. So the payout ratio is going to probably be around 20 to 25% for Salesforce. And with Meta, I think probably somewhere around there, probably a little bit lower. After the payout ratio, the next thing that I want to take a look at is the dividend growth. The dividend growth over the last 5 years compounded, Intuit's at 14%, Microsoft 10, Oracle 14, SAP 6. Now, if I were to guess, I think that Meta is probably going to grow anywhere from 10 to 15%. And that's why I think that here in the next 5 years, I think they're going to be around a top 10 holding in DGRO if things continue, right? It's up for debate. I don't know, but that's kind of my guess. With Salesforce, I think you're going to see a consistent 10% dividend growth rate. And over time, it'll probably average around 8 to 12% would be my guess. So right around 10%. And so if we compare that with Intuit, you can see here that, this is kind of the exciting part, because Salesforce is going to contribute. It's not going to have as high of weighting like Meta potentially would, but it's nice to see that these type of companies are going to become a larger and larger percentage of DGRO. And then when you compare the growth rates, the revenue growth rate of all of these businesses, Salesforce, Intuit, Microsoft, Oracle, Meta, you got SAP here, which is lower. They're all right around 10%. So if they're growing their revenue at 10%, what are they growing their EPS at? It's kind of different. You got 28%, you got 40%. So they're all growing their earnings per share, which is going to directly impact their company's ability to increase, their dividend. And like I said, probably the majority of you out there have probably never heard of Salesforce, and that's okay. The way that I think of Salesforce, it's one of the largest software companies in the world. And a lot of you have probably heard of Berkshire Hathaway or Warren Buffett. Berkshire Hathaway is kind of like an ETF itself, like its own index, because they own so many different companies. Have you ever, do you have Geico Insurance, right? Geico is owned by Berkshire. Have you ever gotten See's Candy? Well, See's Candy is owned by Berkshire. Have you ever, gotten Dairy Queen, gotten an ice cream cone at Dairy Queen? They're owned by Berkshire. So there's many different other businesses that you can see here on the screen that Berkshire actually owns, nearly 100% or 100% outright. And in addition to that, they also own a stake in publicly traded companies like Apple, Bank of America, American Express. And so the reason why I'm showing you this is the way that you can think about this, if you don't know Salesforce, is you can think of Salesforce kind of like Berkshire Hathaway in the technology software space. And the reason why you can think of that is because they've acquired so many businesses over the years and entered into so many different markets. So their total addressable market is just expanding every single year as they take market share in their existing businesses, but also enter into new markets, kind of like an Amazon, right? Like, when we first saw Amazon maybe 10 years ago, they were just selling books, or, you might have bought something online, but now they have AWS. I see Amazon trucks all over the place. They're one of the largest logistic companies in the world now, right? They're ever evolving and ever growing their total addressable market and growing market share and their earnings so that they can reward shareholders. Okay, so those are the kind of the comparisons. Salesforce is kind of the Amazon or the Berkshire Hathaway in the software world. Okay, and when you think about Salesforce, only a small percentage of their revenue comes from their CRM business, their customer relationship business, customer relationship management business. And over my 10-year time in working in tech, almost every single company that I worked at directly competed or partnered with Salesforce. They have such a major footprint when it comes to software, and many businesses, they shape their entire processes around the tech stack of Salesforce. So it's an incredibly sticky business. When a company goes onto Salesforce, Salesforce does not make it very easy for them to churn or to leave. So it's a very sticky business, and that's why they can reliably, as you're seeing here on your screen, year over year, grow their business and grow their TAM. So what makes Salesforce so unique and so special is that they've evolved and grown their business in a very rapid and unique way. They've acquired, the majority of their growth these last couple of years have come through acquisition and mergers. So they acquired Slack, they acquired Tableau, analytics tool, they acquired MuleSoft, they acquired Demandware. I actually worked at a competitor of Demandware. We were competing with them every single day. And, they compete, for example, I didn't work at this company, but they compete heavily with Shopify. So businesses all around the world rely on Salesforce in one way or another. Well, isn't that funny? So I was just finishing recording, editing the video, and just about to upload it to YouTube when I got the notification that Google announced that they're going to be paying their first ever dividend. I'm recording this video here on Thursday. It's about 4:35 Eastern time, 3:30 here in Texas where I'm at. So Google just declared that they're paying a dividend. And this is very similar with Meta and with Salesforce. They're one of the next, FANG or Magnificent Seven to start paying a dividend. It just shows that we truly are in a new business cycle where you have these big tech companies starting to pay a dividend. I think it's only a matter of time before Amazon starts paying a dividend. I think their shareholders and, I think they're going to get a lot of pressure to start paying a dividend. But it's really interesting to see that now Meta, Salesforce, Apple, Google, that they're paying a dividend. The one that I don't think is probably going to pay a dividend right away is Netflix. I don't think it would be wise of them to pay one, but hey, who knows? But really, I guess what I want to highlight here is that with Google, their dividend based off of how many shares they have and how much they would be paying per share. Now, given that there will be a $70 billion buyback, so the share count will be reduced, they're going to have, just out of the gate, they're going to almost be in the top 10 if they were to be added to DGRO. Like, say, for example, as it stands today, in 5 years, so there's no doubt that Google is going to be added to DGRO in 5 years if they were to continue paying a dividend. I'm sure they're going to continue doing buybacks. Dividends will be grown probably just like the others, between 8 to 15%, probably going to be around 10%. The first couple of years, probably a little bit higher, but one could assume that they're going to continue paying a dividend. This is a strategic move from them. This is not something that they do lightly. They put this off for so many years. They're now entering the next phase of growth and maturity of their business. And so I think that they're going to follow suit very much like Microsoft and Apple. So over the next coming years, you're going to see them start being included in more dividend growth ETFs like DGRO and VIG as an example. But when you look at this, just as an example, like we did with Meta, Meta right now would be, if they were part of DGRO today with the current valuation, the current metrics, and the current dividend payout, today they would be in the top 30. With Alphabet today, they would be almost in the top 10. They would be right around 10 to 15, right around that. The reason why it's a little bit difficult, I'd have to run the math, but with the $70 billion buyback, it reduces the amount of shares that they have, but I'm guessing right around 10 to 15, between 10 and 15 in the top holding of DGRO. Now, if we fast forward 5 years from now and they're growing their dividend 10 to 15% as an example, I think it's very reasonable to assume that they're going to be right around in the top 10, top 20 in terms of the top 10 holdings here in DGRO in 5 years. So there you have it, everybody. I'm going to add this here to the video. I thought that was kind of funny. I looked at my phone. I got the Seeking Alpha notification that they created a dividend right when I was about to upload the video. So yeah, there you go. So when you're invested into an ETF like DGRO or SHD, you're not emotionally attached to any one individual company in the index, right? Because the index does change. And I think it is actually a good thing to not get overly emotional about the individual companies in the index that you own, like SHD or DGRO. But it is cool to see and kind of have that feeling of ownership that, yes, I am an owner in Procter & Gamble. I am an owner in Apple and in JP Morgan. And you don't really get that sense of ownership as much investing into ETFs like you do with individual stocks. For example, when I go to the grocery store and I see people buying Coca-Cola, I always think to myself, yeah, I am an investor. I am a shareholder of Coca-Cola. And it's always exciting to see other people purchase Coca-Cola. Or for example, if I ever go and I buy a vanilla Coke, I'm directly, supporting the company and supporting the dividend. I guess it's kind of in a weird way. But you have more of an emotional connection when you invest in individual stocks. And I do like that part of dividend investing, that you truly are a shareholder. And with dividend ETFs, you kind of can lose that. And so when looking and seeing that Meta and Salesforce will potentially join DGRO and I will directly own them in my dividend ETF, big tech in my dividend ETF, it's kind of cool to think about that. And that's one of the great things about being a dividend investor and investing into an ETF like DGRO is if Meta or Salesforce fumble and they cut their dividend 1 year, well, they're not going to be included into DGRO. And that's how it works. It's the survival of the fittest. And that's why I love investing in ETFs, especially as someone who's living off of his portfolio in early retirement. I don't have to stress about it. I don't have to worry about it. And that's what I love the most about the simple path to wealth with dividend investing. And I hope that you enjoy that as well. So thank you so much for watching the video, everybody. I hope that it was helpful for you. I hope that you get excited about this kind of stuff like I do. And I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along. partner.